All right, continuing with the bonds, let's have the discount versus premium conversation. So let's say the face value of your bond is $1,000. The interest rate that you have stated on the bond itself is 10%. And the market is also paying 10% for bonds that are similar to yours. Well, then you'd be issuing the bond at face value. You'd be issuing it for the $1,000 and you'd pay them $1,000. Right? So nothing earth-shattering there. Okay, so now let's take it a little bit different. Face value of the bond is still $1,000, still 10%. But the market is paying 13% for bonds similar than yours. So why is anybody going to buy your bond? Right? How do you make it attractive, right? You're paying out less interest than everybody else. If that's the case, what I have to do is I have to sell the bond at a discount. I have to sell it for some amount less than $1,000. I will still pay the people back $1,000 at the end of the bond, but the original sale would be for some amount less than $1,000, maybe something like $900. So you would buy my $900 bond, and I'm going to give you back $1,000 at the end of the bond period, and I'm still going to pay you 10% interest. Okay, so kind of a good deal. But the idea is that we want our bonds to compare to people that are paying out 13%. Okay. To give you an example of how a discount would be listed, like if you were to look at bonds and how they're listed when they're sold, you would say something like the $1,000 bond is issued at 90. What they really mean is 90%. I don't know, maybe it's just too much work to put a percentage sign in there. But that would mean that the bond would be sold at $900. All right, premium. Same idea, face value, stated interest rate, but the market is paying 6%. Well, now my bonds are paying tons more money than everybody else. So if that's the case, I'm going to sell it for a premium. I'm going to sell it for more than $1,000. All right, the premium would be listed as, you'd say, it was issued at 110 or something like that, or 113. And what that means is 113%. So you'd be selling it, if it was 110, it'd be $1,100. Okay, just the way it is. So when you see things listed that way, that's what they're saying. When they are selling, such and such bond was selling at 90, well, not $90, but it was a $1,000 bond issued at 90. They mean 90%. Okay, so there's a whole calculation in your text on how you calculate the discount and premium piece and how we amortize that and whatnot. We're not doing that. All right, save that for intermediate accounting 2 or 1. I'm not sure if I covered it in 1 or 2, but the point is that's a higher level calculation. I don't feel like it's really appropriate for financial accounting, so this is as much as I want you to know about discounts and premiums right here. Okay. All right, moving along. A couple of transactions for the bonds. Let's show you what the journal entries look like because we haven't done those yet. McQueen Company issued $100,000, 7.5%, 10-year bond payable. So let's first issue it. First thing we do is we get money, right? We're getting cash. We're McQueen. We are issuing bonds. We've got $100,000. Great. And we have bonds payable. Oops, too far. We have bonds payable. All right. We're paying this semi-annually, right, which is twice a year. We're paying out the interest. And remember, the idea with the bond primarily is that we're borrowing $100,000. We're paying interest for the next 10 years. And at the end of the 10 years, then we turn around and we give back the $100,000 that we borrowed. Right? So here we go. We have to calculate the interest. Well, the interest is $100,000 at 7.5% for half a year, 6/12. That's $37.50 in interest. So when we pay that out, it's going to be debit to interest expense, credit to cash. You're going to do the same entry every 6 months until the 10 years are up. When the 10 years are up, you have to get people back their $100,000. So you're going to reduce the liability of bonds payable and credit cash because you've got to give them their money back. Okay. Issuing bonds versus common stock. The idea is that we're looking at ways that a business could fundraise. Ooh. All right. So both are, I'm off. There we go. Both are ways to raise capital from investors, but each has its own positives and negatives. So the idea is if a business wants to expand or, fund its operations and, bring in a bunch more money, right? The idea, raising capital, the idea is that you can do many different things. You can take out the loans that we talked about. You can also issue bonds, right, which are also somewhat loans, or you can issue common stock. Common stock doesn't have to be paid back, but you're basically selling ownership in your company with common stock. So there's pluses and minuses that come along with each of these, right? The negative, bonds have to pay the bondholders back. Stock, like I just said, you don't have to repay. If you were buying my stock, basically you'd give me money. and I would give you stock, a share of ownership in my company, but I'm not paying you back. Like, you've just now invested in my company. You could turn around and sell that stock to somebody else, but I never have to pay that money back. You've just given me money to expand my operations. With bonds, you have to pay interest, right, which lowers capital so that you don't have money hands-on because you are paying interest. You don't have to do that with stock. But issuing stock will likely reduce earnings per share, and we'll talk about earnings per share shortly. And it also lower market price potentially. Because if you're putting a whole bunch more stock out there in the world, what's going to happen? Market price is going to go down, right? Basic economics. You have a lot of stock out there, the price is going to go down. Bonds may still impact earnings per share, but usually not as much. And I think that's all of them. Okay, yeah, that's all of them. So that's all the ones I was thinking of off the top of my head. So let me give you an example of how these things affect all the pieces: earnings per share, net income, all those kinds of things. So here's an example from your book. You have a problem just like this, but it is algorithmic, so you have to work your own numbers. SB Electronics is considering two plans for raising $4 million to expand operations. Plan A is to issue bonds. Plan B is to issue common stock. Okay. Before any new financing, before you engage in this expansion, you already have net income of $350,000 and 300,000 shares of common stock outstanding. Management believes the company can use the new funds to earn additional income of $700,000 before interest and taxes. Income tax rate is 30%. A lot of stuff going on here. Now the idea is we're only looking at two plans. If you were really the accountant, you would look at a multitude of plans. You'd look at, what if we raise some stock? What if we sell bonds? What if we sell some bonds and some stock? What if we just do stock? So you'd have any number of different plans. But you can't, that's the job as the accountant, is to look at this and say, well, what happens if we do this? What happens if we do that? What happens, right? It's projections. This is what we're doing. We're projecting what the effects will be of each of these plans. Okay, so plan A, we're going to issue just bonds. So we had $350,000 before, right? That was our normal net income. And if we take on this new project, we expect it to be $700,000 of additional income. Great. But with bonds, we're going to have to pay interest, right? So if we issued 4 million bonds at 9% interest, there we go. That's going to be $360,000 of interest. That's going to take a big chunk out of that new money we're getting there. So the income before 700 minus 360 would really net 340 of income from this expansion, because we'd have to pay for the bonds. But we also pay income tax, right? That doesn't go away. So if you're making an extra $340,000, income tax is 30%, you're looking at income tax of $102,000. So now really the net income from this project is really $238,000, right? So the idea is you'd have to subtract out the interest expense from the bonds, and you'd also have to subtract out the income tax expense. So you'd be at $238,000 from the new project. That $700,000 just came all the way down to $238,000. So you had $350,000 before. You're going to have an additional $238,000. Your new net income number would be $588,000. Okay, so now let's talk about earnings per share. Earnings per share is calculated as net income minus any preferred dividends over common stock outstanding, number of shares of common stock outstanding. We're going to talk about this a lot more in the next chapter too, but this is the basic calculation. We don't have any preferred dividends right now, so don't even worry about that. We only have net income, and we have the number of shares of stock outstanding. Well, the net income from this new calculation is $588,000. Okay, $588,000 is your numerator, your net income. And your 300,000 shares comes from up here. You had 300,000 shares of common stock outstanding. So your earnings per share is $1.96. Now, earnings per share is the only financial ratio that is actually required to be put on the financial statements. Earnings per share is just kind of one of the most basic ones that people think that they understand. Meaning, it's kind of like how much does the company earn for every shareholder, every common shareholder. It's kind of what the calculation is. So the higher that is, the more the company's earning for them. Great. It's, like I said, there's any number of financial analysis tools and ratios and calculations you're going to do, and that's going to be actually the beginning of managerial accounting for you. But this is the one that is the most commonly referred to. All right. So earnings per share is an important number because companies know that investors watch that number. So they like to keep their earnings per share at a decent amount, right? So in this case, it's $1.96. Is that good? Is that bad? There's really no way to say if it's good or bad. The idea is you're looking at it in comparison to previous years or other companies, right? A number standalone doesn't mean that much to you, but when you're comparing, then it does. But anyway, so the point I want to make is that earnings per share number is something that gets watched. Okay. Let's go with plan B, 4 million shares of common stock, or $4 million worth of common stock. So we still have the same net income. That didn't change. We're still looking to make $700,000 on this expansion, but now we don't have interest expense because there's no interest that needs to get paid. So the project income before the tax, you're bringing in the full $700,000 because you don't have to pay anything extra out, right? Because we're issuing common stock. We do still have to pay income tax at 30%, so that's $210,000. So the net income, the amount that we're getting from that plant expansion or the operation expansion is $490,000. So you have far more money to work with in this situation, right? You've got $490,000 out of that 700 versus the 238, which is a pretty significant difference, right? You have far less money to work with because you had to pay out all those darn bondholders all of their interest. So the new net income number would be $840,000, which is a $350 plus the new $490. You're at $840. Now let's see what happens to earnings per share, because what you've just done is you've increased the number of common stock outstanding. So what you've done there is you've kind of diluted it, right? You've put more out there. You increase that denominator number. So we've got $840,000 as our new numerator, over 800,000 shares of common stock, because we had 300. And we're issuing 500,000 more in this plan. So, there you go. That comes out to $1.05. All right, clearly that's a far lower number to $1.96. You have to say what you wanted, what was more important to you. More cash on hand and you don't care so much about earnings per share, or maybe you care a lot about earnings per share. You don't really care that you don't have as much cash on hand. It's going to be up to you as the company to make that decision. All right, and that's it. Have a good day.